Afternoon, everyone, and welcome to today's webinar on preparing for Nacha's 2026 Fraud Monitoring Rules. My name is Jennifer Ballantyne, and I'll be your moderator. We are thrilled to have two distinguished speakers with us today. If we can get to the next slide, please. Today, we have joining Amy Morris, AAP Senior Director of ACH Network Rules at Nacha. And we also have Brian Holbrook, Director of Product Strategy and Integrated Services for LSEG Risk Intelligence. Before we dive into the content, I'd like to cover over a few housekeeping tips. This webinar is being recorded, and we will send out the recording along with any relevant information after the presentation. We will have a dedicated Q&A session at the end, so feel free to submit your questions in the questions section throughout the webinar. Today's focus is on how organizations should be preparing for Nacha's 2026 fraud monitoring rules, now that we're just 1 year from implementation. In 2024, organizations were in the research phase, learning about the rules and assessing their fraud detection gaps. Now, in 2025, we're in the execution phase. Where should organizations be finalizing vendor selection, upgrading fraud detection systems, and preparing operational changes? Thank you all for joining us, and let's get started. So we're going to kick off the webinar with a poll question, if we can bring that up. And that's up. Our poll question we're asking everybody is, how ready is your organization for the new Nacha 2026 rules? We have a few selections here. We haven't started yet. We're still assessing what's required. We've begun planning and vendor evaluations. We're actively implementing changes, or we're in the final testing and validation phase. I'm very curious to see everyone's responses after we did this about 6 months ago, and people were still trying to figure out what they were going to do. So interested to see how the progression has started. People coming in. I think we have the majority of our respondents in. So if we want to kind of pop up the results and see what that looks like. All right, so it looks like majority of us are still assessing what's required. So not surprising at all. We're hearing that every day and hopefully be able to address some of your questions across the board. Oh, numbers keep kicking in. So hopefully by the end of the session today, we'll be able to get many of your questions answered and get you on the right path. So with that, Amy, I'm going to go ahead and pass it over to you to share some recent ACH stats and information. Next slide, please.
Thank you so much, Jennifer and Brian. Thank you all for joining us, and thank you to LSEG for having me. I'm very excited to be here to talk to you all about what's coming up in 2026 with regard to Nacha's risk management rules. It's exciting because we want to reach as many people as possible because these rules touch everyone. So I'm so glad that you've taken the initiative to be here and learn about what is necessary. So if we go to the next slide, we'll take a quick look at some volume figures. What I have here is 2024 annual volume. Unfortunately, we're just a shy bit close from being able to release our first quarter 2025 figures. I think they're actually going to come out next year. But when we look at our 2024 annual volume and in comparison to the previous year, it really underscores why we are all here, right? The ACH network truly is the backbone of commerce and economics here within the US, processing 33.6 billion payments. That's over the network. That isn't even including what we call on us payments. So that's where the merchant or biller or what we call originator is banked by a financial institution that the receiving account is also banked by. And so those might not go through the network. So when we add all of that together, we're adding an additional 5 to 6 billion payments on top of that. So you can see the magnitude of the impact of the ACH network and ACH payments in the US, totaling over $86 trillion last year. When we look at the breakdown of how those payments shake out, when we look at the number of payments, Traditionally, we've always been a little bit more debit heavy. So the ACH network is unique, basically throughout the world, in that we are equally supportive of both the pulls of money out of an account as well as the pushes of money into an account. So when we look at the actual number of transactions we processed last year, we're staying steady with our trend, which is, a little bit less than 60% on the debit side. So those are pulls of funds out of an account. Like as a consumer, I can sign up to have my mortgage payment pulled out of my account. But when we look at the dollar value of transactions, it's actually the credit transactions that have the big majority there, almost two-thirds there, of the value. And, I think that makes sense. I think even on an individual level, we would hope that the amount coming in is more than the amount going out, and that's what the network reflects. We've still been experiencing very strong growth. And when we talk about these kinds of numbers of 6.7% in volume and 7.6 in value, it helps to be able to put it into context of what's above it, right? That baseline. These are not small numbers that we're talking about. So a 6.7% increase, um, when we're talking about billions of payments, is significant. And so that's really why we're all here to continue to talk about transactions that are processed through the ACH network. So if we go to the next slide, you'll get a little bit more of the in-depth volume information. Number one growth uh, type of transaction is our is B2B. So we've got two different types of B2B transactions, one that holds more remittance information than the other. But when we look at the two of them together, that is the biggest bucket that has been increasing in the ACH network. And that's been for a number of years, basically since the pandemic, and it doesn't seem to be slowing down. As a matter of fact, it actually seems to be increasing. So last year we did 11.6% more B2B transactions than we did the year before. And that's almost a full percent higher than the increase from the year before. So lots of growth in that B2B space. Some of the other, there's some, nice snippets here about thinking about how ACH impacts everyday folks. But I will basically say that the three biggest buckets in the ACH network are B2B. The biggest bucket is what you see on the bottom left-hand side of the screen, which are what we call the internet payments. When we talk about our volume breakdown, this is specifically consumer payments. Consumers that are authorizing debits out of their account, so pulls out of their account over the internet or some kind of, text, basically an unsecured network mechanism. So text, mobile app, etc. Still seeing very strong growth there. And when we look at the numbers, 10.7 billion, that is the biggest bucket of the ACH network. The next biggest bucket is what we call direct deposit. Those are, if you're familiar with our standard entry class codes, those are P2P credits. So once again, we're talking about consumer payments from a business to a consumer of a push of money. So the internet's are consumer to business pulls, and direct deposits are business to consumer pushes. So that's your direct deposit of pay. That is your benefits. When you think about federal government benefits, retirement benefits, state government benefits, tax refunds, uh, insurance payouts, all those things are under that bucket. It is the traditional ACH use case, and so we're very comfortable that it still remains with strong growth at 3.7%. I will tell you, unfortunately, we don't have our fourth quarter numbers ready to present yet. We're a couple of days shy of that, but I'll just give you a little bit of, some inside baseball here of what we're seeing is very much in line. We're not seeing anything different at this point. We're still seeing very strong, especially commercial growth volume in the ACH network. It still falls under the same three big buckets of B2B, direct deposit, and internet. So again, B2B, obviously being business to business, those consumer pushes of, or sorry, pushes to consumers is what I meant to say, and then pulls from consumers as well. So I don't expect, I'm excited that we'll be able to announce those numbers hopefully before next week, but I don't think you're going to see a different trend than what I'm explaining here. So if we go to the next slide, we'll talk about same day ACH for a second. So what I just went over was the network as a whole. But when we, oh, I'm sorry, we'll go back one more. Um, but when we talk about same day ACH, so those are transactions that are processed and settled on the same day, we're not seeing much different patterns. So first of all, though, the growth is fantastic. When you look at the growth, the number of transactions, 45.3% over the previous year, value 33.3%. So just keep in mind that the year before we had actually increased the limit on ACH same day transactions. So we saw a bigger increase in value that year, but now that we've had a full year of that new limit being in place, we're still seeing the growth on the volume side. 1.2 billion payments. This is the first year that we passed a billion payments. For $3.2 trillion on same day. And when you look at the breakdown of those transactions, it really mirrors the network as a whole, both from the type of transactions, the number of transactions in the network. It's slightly more debits than it is credits, but when we look at the value, it is bigger on the credit side than it is on the debit side. And then I'll tell you about, the various tranches within that. It again mirrors the network as a whole. The three biggest are consumer internet, again, internet debits, those consumer credits from organizations, direct deposit, and then B2B. Those are the by far the biggest buckets of number of transactions and where we're seeing the growth within same day. So I'm saying all of this to you basically to explain why it is so important that we take risk management in the ACH network seriously, because we're talking about the vast majority of transactions that are happening here within this country. So we can go on, please, to our next slide and start to take a look at our risk management rules. There's a number of them that have already come into place. So we've already gone through our October 1st, 2024 implementation, which really was about tools. And so these are tools for when the worst happens. We've provided through our rules an expansion of tools to both the sending side and the receiving side financial institutions to be able to recover easier. We just went through our most recent sort of phase 2 implementation of that set just a couple of days ago, or I guess I should say last week on April 1st. But these really are pieces of the puzzle that we're going to talk about in just a second that allows for financial institutions to work together on behalf of their customers to try to recover when the worst does happen. But what we're really here to talk about more is trying to prevent the worst from happening so we don't have to deal with recovery. We just don't, allow these transactions to happen. And those are our rules that are coming in 2026. For phase 1, that's March 20th. Fraud monitoring of all ACH transactions will be required on March 20th of 2026 for all ODFIs. These are all financial institutions that submit transactions into the ACH network. It also covers large volume originators, third-party senders, and third-party service providers, including third-party senders, with 2023 volume of 6 million or greater. So that's sort of the cutoff to know whether you're in phase 1. But basically, this is everybody that's a large party to origination that's not a consumer. Also on the RDFI side, that's the receiving depository financial institution side, we have phase 1 of ACH credit monitoring. So we have new requirements for the receiving financial institutions as well to be able to have policies and procedures in place that will help to identify transactions, ACH credit transactions that are potentially unauthorized or authorized under false pretenses. And then we also in March have some new company entry descriptions that are going to help both on the sending and receiving side as we're doing this monitoring and putting these policies and procedures in to be able to definitively identify what certain types of transactions are for and therefore how they should act, and then what is anomalous activity. Key date here, the second key date is June 22nd of 2026. At that point, we cover everybody. So even if you aren't in these large volume groups by June of 2026, if you're not a consumer, basically you're covered by these rules. So let's go ahead and go to the next slide. And I just want to mention again how all these are intended to be pieces of puzzle that fit together. So fraud monitoring by all of the parties that are involved on the origination side is intended to catch those transactions or prevent. Even if one slips through, then the goal is the second one we're going to prevent, right? So by identifying transactions that are unauthorized or authorized under false pretenses, we can then stop activity from the sending side from getting into the network. So as I mentioned, that standardized description piece, it fits for both, right? So on the sending side, it makes it easier to have systemic processes in place that read a description and know what a transaction is, what it's supposed to look like, what it's not supposed to look like, to help us be able to act within those processes and procedures, to be able to identify where something might be, again, unauthorized or authorized under false pretenses. But if something does get through, we do have the requirements on the receiving side. So RDFI stands for Receiving Depository Financial Institution. They also have requirements for monitoring their incoming ACH credits. They can't be passive receivers any longer. They have to identify, again, what could be unauthorized or authorized under false pretense uh, activity. And then we've given the tools to both sides to be able to work together. That's the exemption from funds availability, to take a little bit more time to research transactions, the ability to return them, the ability for the sending side to ask for that return. So expanding those tools for folks to be able to work together in case we've missed the ultimate goal of preventing the transaction from getting introduced, that we can at least handle the recovery. So if we go on to the next slide, please. I want to call out, if you haven't seen the 2025 version of the Nacha operating rules and guidelines, please get access to it. This is the largest change to the guidelines that I can remember in at least 20 years. I've been involved with Nacha. I've been working for Nacha for 12 years. I've been involved with Nacha for over 25 years. This is the most significant change that we have made to provide information to users about the descriptions of scams, suggested internal controls, issues that you need to consider when complying, and monitoring guidance for all different kinds of parties. And it was such a big deal that we actually did a supplement last year, which we only normally do for rules changes, not guidelines changes. But I really encourage you to take a look at that. And then on the next slide is just a little bit of a summation of some of the thoughts around the sending side controls. So first of all, we say under the rules that there needs to be a risk-based approach. You can't conclude there's no monitoring at all needed because I have no risk. That's not the case for anybody. We don't require monitoring to happen prior to the transaction processing under the rules, but if you don't do it prior to transaction processing, you can't stop it. So there's pros and cons to look at, excuse me, either way, and we're going to talk about that. And then again, this is just very high level. The guidelines get into much further detail, and we can talk about those questions today about what to do if my processes and procedures start to flag something. So there's options to stop the processing, consult with different parties, whether that's on the receiving end, whether that's internally of other groups that are looking at anti-money laundering, as well as other types of schemes that may be going on, where you could see commonalities between your ACH operations activities as well. Um, And then even potentially working with financial institutions to gather more information to determine whether that transaction should move forward. But I want to finally just mention that one of the key aspects of these rules is the ability on the sending side to work with different parties. The ability to be able to say, I am in this role and I'm best suited to do ABC. You, as a vendor partner, are in this role and you are best suited to do XYZ. You, as my financial institution partner, are best suited to do one, two, three. And that is very much accepted under these rules, provided there's an underlying structure, such as contracts, that dictate that kind of activity. So I'm gonna go ahead and pause here, and please ask Jennifer to take it away from here.
Thank you so much, Amy. So as we can see, faster fraud isn't always, or faster payments doesn't always mean faster results and less fraud, right? So thank you so much for going through all the different changes. We have a couple of questions that have come in that are going right along with what you're presented today. As a quick reminder, some of the questions popping in are, is the presentation being recorded? The answer is yes, and you will get a copy of it. And then will be handouts that we sent to you after the presentation as well. So I can just throw that in there. But there's a couple questions that we've had come up regarding the different changes that are coming through. So one of the questions that popped was, what's the minimum I need to be compliant? I know you've talked before in the past that there's really not one size fits all answer. So would you mind elaborating on that a little bit?
Absolutely. So you're right. There is not a one size fits all answer. And that's a challenge for Nacha, where we're trying to write rules that are going to cover financial institutions of all different kinds of sizes, as well as organizations of all different kinds of sizes. Our rules cover an organization that does 5 ACH transactions just as well as it covers one that does 5 million ACH transactions per day, right? So we can't get too prescriptive. Um, and that's where we're relying on this rule language that says that a risk-based approach is critical. So provide the key point there is to look at your risk assessments. And if you haven't done one, that's the first thing that you need to do. But the key here is to be able to identify transactions that may have been initiated unauthorized or through um, false pretenses. And so part of that really has to do with, I won't even say part of that. I think all of that has to do with understanding what normal activity is for your customers and then being able to identify what abnormal activity is. And that's going to look very different depending on your type of organization, and your size, et cetera. But it can mean a lot of different things where you might have procedures where we're looking at velocity. We're looking at the number of transactions we have to an account. We are looking at the number of transactions that we have to a certain name. We're looking at overpayments. Does the amount of the payment make sense? And then we start talking about things like account validation and and account ownership. Again, depending on your risk, not your depending on the risk level that your transactions are encountering, that is very possible something that makes sense to help you to identify where transactions may be being created in an unauthorized or fraudulent manner. And so, as an example, when we're talking about impersonation fraud, where somebody's tricked into sending a transaction, account validation is something that can help you to make sure that an account is good. And when we're talking about owner verification, that can help us to identify things like where I think I'm sending it to ABC Paving and I'm sending it to, Amy Morris. So again, it doesn't look the same for everybody. And the key there is really to look at your risk assessment and then what is the best type of methodology to handle your higher risk types of transactions.
Thank you. And I think the follow-up question I have on here is, I went back to our poll a moment ago, and it looks like 67% was the final number we landed on. Fell in the bucket that says we're still assessing what's required, and about 12% was we haven't started yet. So what advice do you have? I know with our customers here at LSEG, we get the questions of that rising concern about, am I ready? And some organizations are realizing they're a little late behind the ball on that. What advice do you have to be able to get people feel like we still got you and you can, it's not too late. You can still make sure you're protected and following the rules.
Yes, I mean, you still have time. It is, I want to say it's like half panic time, right? So the first thing I recommend, like I've said a few times, is making sure that you've got an up-to-date risk assessment for you and for your clients. Again, it depends on where you fit within this chain of origination, right? Um, but that's the first thing, and then start to identify the mitigations for those higher risk activities. Now, again, the rules, to be fair, the rules only require processes and procedures. And so that's where I said it's like half panic time. At least if you have some processes and procedures in place by March, you're going to be okay. But I don't know that that is really your long-term goal. And so as a result, I would say that, time is critical, and we really want to start making those gap assessments between our higher end risk transactions, and what could help us to identify those. Also determining where in the processes we're going to run these procedures, how that is going to how that is going to impact our processes where we're identifying different types of transactions and how we treat them, meaning exceptions back potentially to our end users. And we need to start identifying all of those pieces immediately. And so yes, time is of the essence, but I think that there is an ability to look at this as a phased approach, um, but you don't want that phase to push out too long, because this could quickly, start to become something that you're very soon realizing I need help with. Um, and so those assessments and gap assessments are really critical right now, and to start to determine those requirements.
Thank you so much. Brian, I'm going to kick it over to you. So how does this resonate with what you're hearing from the industry? I'm going to give you a couple of pronged approaches. What are you hearing in the industry, and what concerns or frequent questions are you hearing from our clients? Are you seeing any common challenges across the board?
Yes, absolutely. We're seeing a lot of challenges with our client base around timing and resources, and that is really making sure that they are putting these items on their roadmaps, allocating the proper resources, and they're doing the required vetting of existing partnerships, new partnerships, looking to find the most value, not only to meet the rule requirements, but to really touch on what Amy is talking about, and that is not just meeting that minimum requirement, but you're meeting the requirements of the Nacha rules, and you're really improving the process for your customers, protecting your own risk profile, protecting your consumer, and protecting those accounts, and reducing that fraud as much as you can.
Thank you. So we know what's coming, but the big question is are organizations executing their compliance plans? So let's go ahead and jump to where companies should be right now. So if we could do the next slide, please. So Brian, we've outlined a four-stage roadmap for compliance. Where should organizations be today if they want to meet those deadlines? I'll kick it over to you.
Sure, absolutely. So really, there's a four-stage approach here, and in stage one, which was really in the time period of 23 and 24, is really looking at what the rules assessments are, understanding what those challenges are, what are you doing today, what do you need to be doing tomorrow, and looking at those guidelines, and assessing what changes and improvements need to be made in order to provide the right amount of friction to the right types of transactions to the right types of customers, so that you are in compliance and reducing that fraud. Within stage two, we're really talking about the business process flow and re-examining the entire end-to-end process from vendor evaluation to implementation. Stage two is really about the opportunity to really take 3 or 4 steps back from what you've traditionally done, and examining where you are, where you can go, and to the extent that you can sort of try to future proof and make it easier to make additional changes in a future state. When we talk about stage 3 and we're talking about resource planning and project implementation, that's really where we are right now in 2025. And that is having a clear plan of execution in place. We've identified our resources, we've allocated budgets, we've gotten those approved. We've got the internal and external teams, both across risk, treasury, compliance, IT, and our partners, that everything is aligned and we're ready to kick off an implementation project to meet these requirements. And I would say lastly for stage 3 is the technology integrations, the system upgrades, the processes and challenges that should begin now around that implementation. Lastly, then we're looking at stage 4, which is compliance. Now, this is where we're looking at late 2025, early 2026, that we're testing our methodologies. Do we need to make any additional changes? Are there any gaps in any of the processes or products that we've put in place to catch these things? And that gives us the opportunity to really do some fine tuning so that when we get to that March 2026 deadline, that we've really got a very refined, fine-tuned process in place, ready to go to meet the regulatory requirements and to provide the best possible outcome to our customers and to our risk profile.
So then a critical part of execution is ensuring that fraud protection is embedded throughout the customer life cycle. We talk about this often, I think every day, right, Brian? So too often organizations we're seeing are only focused on just the onboarding and neglect the ongoing risk of monitoring. So with the next slide, Brian, could you help get a really closer look at the customer life cycle and focus on what fraud prevention processes can be put in place for our customers?
Sure, absolutely. So we're really talking about multiple things here, right? We've got multi-layer identification processes. We've got behavior and predictive analytics, and we've got account ownership and payment information matching. And I actually have a personal story that I can share on this. That I have seen. I work with 2 different financial institutions on a personal level, and I have had to move money between those 2 accounts. One of those accounts is relatively new. I'll say it's less than a year old, but more than 6 months old. And I attempted to move a relatively small amount of money between one account and the other. And I got text messages, emails, and phone calls from the new receiving bank that I had not experienced before for them to look to understand, was that me who was really moving that money? And looking for additional authorizations from me to ensure that this movement of money was both initiated by myself, it was not part of an account takeover, and that it was indeed the account that the money was coming from was owned by myself. So I'm seeing, at a personal level, I've seen financial institutions starting to put these pieces in place, and they're fine tuning those processes to create friction where it was necessary, but making it easy for me as a consumer to move money between those accounts.
I think we're on to the next slide.
And so here, again, change management, right? It's about making sure that from onboarding through the life cycle to making changes. If I were to add, for example, in the real life example that I've experienced, if I were to add yet another account to my movement of funds, am I authorized to do that? Am I making sure as a receiving or an originating financial institution that I have all the proper pieces in place to ensure that we are avoiding things like account takeover, that we're using multi-factor authentication? Are we monitoring? It can never be, and over the course of the multiple webinars that we've done, one of our mantras has been, is that it really has to be life cycle. It's not a once and done. It's that we're always monitoring that customer, that account, that movement of funds. Are we seeing velocities that are not in sync with what we may have seen with that consumer's behavior in the past? Are we seeing multiple new accounts being added in a velocity that is out of the norm for that type of customer? And just that ongoing monitoring and having those triggering events for automatic review of certain types of transactions, possibly putting holds on receiving of funds, putting holds on the movement of money or leaving an account, and any additional manual reviews that may be needed if they're outside of certain parameters.
So it sounds like the main question to ask is really, how do you verify that a change request is actually coming from their legitimate account owner, right, and not a fraudster? Is what I'm learning from you today, correct?
Correct.
Perfect. I think on the next slide, we'll actually get into it. So we've talked about onboarding the customer, making sure we know the person. If there isn't a change events, make sure that account takeover hasn't happened. And it's time to send the money, Brian. What should we learn from our lessons here?
So really, it's we're looking at real-time account status and risk screening. Is it an open and active account? Is that account in good standing? Has there been any associated fraud events with that account in the past? Are we looking at the ownership of that account? What do those outbound payments look like? Are we requiring any business verification for matching for an ACH disbursement? Are we using risk scoring models for new payees, especially if they're a large value, as we've seen over the last 2 years now, the big increase in the amount of money that you can move through the network, moving up to $1 million? And what are those limits and those velocities around what we're monitoring? And are we having different monitoring levels for different types of consumers? Applying that appropriate friction where it needs to be for those higher risk potential accounts or customers.
Perfect. If we can go to the next slide. So, Brian, let's talk about actual execution and action. Can you walk us through a real world example of how one of our clients tackled ACH fraud to get ahead of the new Nacha rules?
Yes, absolutely. We've been able to do a bit of an internal case study with one of our customers who will, of course, remain anonymous. They're a financial service institution that work with research, with medical, with different types of government entities. And what they found is that they were working in a very siloed environment. One area of their organization may have a set of requirements for movement of funds, while yet another department had a different set of requirements for movement of funds. We were able to work with that client to bring together a unified approach to making sure that each of the departments that had slightly different needs had a unified approach to each of the steps in moving money, whether that was opening a new account, closing an account, moving money from one account to the other. And that was able to provide them operational efficiencies across the different departments and different entities and different types of consumers or customers that they were working with. And ultimately, what they ended up seeing was a 76% increase in efficiency across those accounts and across their ability to apply friction where it is needed, and then to allow funds to flow from one account to another where that friction may not have been needed. So ultimately, that adoption rate led them to a 66% reduction in resilience in call center staff, which allowed that staff to be more focused on other higher risk transactions. It allowed their customers to be more effective and have a better consumer experience while moving money from one account to another.
That's awesome. Thank you so much. As expected, every day we keep getting added new use cases to be able to make sure companies are getting in compliance, and we're getting more and more wins like this across the board. So thank you for sharing just one example today, Brian. We're going to jump to the Q&A session. Expected we were going to have a lot of questions, and we did not underestimate. So we are going to ensure that we are getting to everyone's questions across the board. So before we do, continual questions is the presentation being recorded? The answer is absolutely yes. So if we can jump to the Q&A session, we are, yes, we're going to go through Q&A and get together. So I'm going to actually start over to the Q&A. So key takeaways we're going to talk about again at the end of the presentation is that if you're still assessing the rules, it's time to make an action, right? So to Amy said earlier, is that it's not panic mode, but it's time to get in gear. As Brian shared today, is the fraud monitoring is not just about onboarding. It must actually cover the full payment process life cycle. So not just on onboarding, change management, and also when you are actually sending the funds as well. So a lot of our questions are going to answer all of those. So Amy and Brian, I hope you have your thinking caps on, because they are firing at us right now. So the first question I have is actually a great one. So we see a common theme across the board is what's your advice for organizations that are still in the early planning phase, and what should they prioritize first? Amy, I'll let you go first.
So thank you. I think the key again is really to look at your risk assessments across all of your different transaction types. We've had rules in place for those online consumer debits for a number of years. And I think looking at how you can, if you are an originator of those types of transactions, how you can extrapolate those types of methods out to all of your different transaction types, B2B, consumer, debits and credits. So I will say, I saw a few things in the Q&A that says, what does this cover? On the origination side, it covers everything. You have to monitor all of your ACH activity, debits, credits, consumer, non-consumer. And so I think really getting that holistic view together and starting to analyze those risks are really what is key. And then starting to extrapolate where you could potentially use some of the things that you're doing today, but then how you can expand. So I mentioned things like velocity and volume, account ownership, really looking at how you can leverage partners to do, like I said, ABC while you're doing, X, Y, and Z. I think that is truly, where we need to start. I will also just go ahead and give a quick shout out that there are pages on the Nacha website that do provide more in-depth information, both from an FI point of view as well as from an end user point of view of different things that you can start to look at in terms of analysis of your activity. But it truly all boils down to what I was saying is it's learning about what is normal to be able to better recognize what is abnormal and finding the tools that can help you quickly do that. So, again, if you're expecting a transaction to be going to a certain account, figuring out that nope, that's not the account that I thought that it was going to, that's a key element of preparing for these rules.
Thank you, Amy. I have one for you, Bryce. So it says, in your client work, how have you seen teams successfully get buy-in across departments like IT, risk, and compliance for fraud prevention upgrades?
What I have seen is the key is to get early adoption, and that is to get all of those various areas involved as soon as possible in the process, so that you're really impressing upon those different areas and those different stakeholders the importance, the criticality of complying with the regulation, and some of those other things that go along with that, and that is, potential reputational risk, and really getting that early adoption, that early buy-in from all those key stakeholders. That's really what's critical.
Amy, I've got a couple of people asking, how in the world is Nacha going to be auditing this new rule for credit monitoring? Are you really auditing what's happening there?
So we're not really changing much from our perspective because similar to card rules, our rules, it's a series of contracts, right? So our enforcement reaches to financial institutions. And so if we get a notice of potential rules violation, we investigate with the financial institutions. And so you're not going to see so much from NACHA in terms of the enforcement, but where you're going to see the changes in agreements, et cetera, to prepare for enforcement are going to be from either your financial institution or if you utilize what we call a third party sender, which is a vendor that kind of sits between you and your financial institution. Those are the parties that originators have the agreements with that bind them to our rules. So they in turn sign these contracts with either the FI themselves or the third party sender who then has a contract with the FI themselves. And that those contracts basically say that the FI, if they get called upon to justify some kind of compliance, they are going to then rely upon their client and it is going to dictate what they are expecting, whether they are expecting for you to show compliance ahead of time, meaning they want to see audits, they want to see proof of compliance, they want to see all these things perhaps on an annual basis. All these different kinds of things can be included, but that's not from the NACHA perspective. That is from the agreement between you and excuse me, I should say an originator, the initiator of a payment, and either the financial institution or the vendor that you're working with. So I would expect, because as I said, there is the capability through these rules to rely on other parties to do functions according to the role that they play in processing, I would expect to see changes to those agreements for both what is being relied upon as well as any kind of expectations of proof of compliance or what they may have in store for proving that, or any kind of enforcement reactions that may come um, as a result of a lack of compliance. I would look for that in those agreements. So again, it's a little bit of chain of reaction there.
Thank you. Brian, we have a question asking, how can a company do owner verification on bank account information?
So this is where we have a number of different types of products and services that would allow our customer to be able to do an inquiry to confirm that Brian Holbrook is, not only is that account open and valid, but is Brian Holbrook an authorized signer on that account? And I would say a step beyond that, when you really look at onboarding or a change management, you've also got the component of that sort of ongoing monitoring. And that is if you've onboarded Brian Holbrook and he's an authorized signer on that account, to periodically continue to check to make sure, is Brian still an authorized signer on that account, or has he been removed from that account? This is a way to allow our customers to be able to not only properly onboard and offboard as needed, but to continue to monitor that person is still authorized to use that account.
Amy, I have a barrage of just technical questions. So if you don't mind, I'm going to put you on the spotlight for a few not just specific rules, if that's okay.
Okay,
The
let's go
first
for
question
it.
I have is fraud monitoring phase 1 for ODFIs. Does this include outgoing direct debit monitoring pool or only outgoing credit monitoring?
So for the sending side, so that includes ODFIs, third-party senders, third-party service providers involved in origination, originators, et cetera. It is ACH fraud monitoring. So again, it includes all types of transactions. That is debit origination as well as credit origination for consumers and non-consumers. So a lot of folks do that are, in the ODFI space, they do have procedures in place currently to monitor their debit returns. And so that's a great place to start when we're talking about, trying to prevent fraudulent debits, et cetera. And so again, you kind of got a leg up there. But for the March 20th date for 2026, when it comes to ODFIs, it does include debits and credits, consumer and non-consumer origination.
Thank you. The next one is, are there any controls or recommendations to cover situations where an excess of false positives from the other party in the transaction occurs? Example, RDFI is successfully flagging or stopping transactions that the ODFI believes are legitimate.
I think at that point, communication is key. The RDFI, again, it depends a bit on whether you're talking about debits or credits, right? Because in the debit space, you can start to move into a potential situation of receiving account abuse or first party fraud. But when we're talking about credits, the RDFIs also play a key role in identifying what should be normal activity for that receiving account. And so if the receiving institution is hesitant on accepting that activity for their own account holder, I would say you need to listen to them. And at that point, there needs to be some kind of communication, whether that's phone calls or communications through secure channels like, our Nacha's secure communication module, things of that nature. But at that point, you would need to take a look at why this is happening.
And the final question, I'll get you off the hot seat, Amy. The final question I have, Brian, is kind of tied together. So I'm going to put two questions into one. Can you give us an example of what does real-time verification actually mean? And then how do firms introduce real-time validation solutions that will replace microdeposits? Would you mind shedding a little bit of light on that?
Sure, absolutely. Over the last several years, we've had several new customers and existing customers really migrate away from the micro deposit model. Moving away from that model allows our customers and their customers to have real-time access, real-time onboarding, so that you're not waiting that 2 or 3 business days to check that micro deposit. So you're having a higher throughput of customers. You're having a more streamlined approach, and you're getting a better validation. It's just not a matter of did that 2 cents or that 3 cent deposit actually show up in that account. The tools that we have to offer and that they can put in place are actually not just making sure that the account is open, but that that individual is authorized to sign on that account. It allows them to put into place something that is far more real time versus waiting 2 or 3 business days for a validation of a micro deposit. So we've seen a lot of migration away from micro deposit and into a real time form of validation.
Thank you so much. Guys, I would love to get through. I think we could be here another hour or two to get through. I think I've got 100 and something questions left over. So we will do our best to answer offline any questions that you submitted in. So thank you for getting the questions in, and we'll try to get our answers back to you as soon as possible after the webinar. So again, I want to thank you all. If we can go to the next slide, please. Thank you all for joining today's webinar on preparing for Nacha's 2026 fraud monitoring rules. We hope you found the information valuable and insightful. As a reminder, again, we're sending out the recording and relevant materials from the presentation shortly after the event. So keep an eye on your inbox after the resources. Key takeaways we talked about again today was that if you're assessing your rules, make sure you're executing on them now. And then for further conversations, we invite you to come visit us at our the Nacha payments event over in New Orleans. We're going to be in booth number 1002. We are actually hosting 2 demo sessions in the Innovation Center. We invite you to join us at that time. And you can, of course, schedule a consultation to assess your readiness right there at our booth. Thank you again to our special guests, Amy Morris and Brian Holbrook, for sharing your insights and expertise today. And we hope you all found the webinar informative and helpful as you prepare for the upcoming rules. Thank you all again so much for joining, and you have a wonderful rest of your day.